Welcome back to FTfm. Climate change presents profound challenges to institutional investors. Joining us to discuss how asset owners and fund managers should respond to the risks presented by global warming is Jane Ambachtsheer, the chair of the Responsible Investment team at Mercer, the consultancy. Welcome, Jane.
Thank you.
So the timing and magnitude of global warming is highly uncertain. How do investors just even begin to factor climate change into their investment decisions?
This is a big challenge, and exactly the reason why about a year and a half ago we launched a major study trying to quantify the potential impact of different climate scenarios. So we worked with 18 different partners, and in June we launched a major study which published our findings. And we developed a scenario-based approach looking at 2, 3, and 4 degree warming kind of scenarios around how those scenarios might impact investment performance. So we modeled the potential impact at the asset class level and also at the sector level, really to try and create a framework and a tool for investors to kind of have a better sense of how these scenarios might impact their investment risk set, but also the opportunity set, and allow them to position their investment portfolios accordingly.
And I think this was the first time that this kind of analysis had been done right down to the sector level. And so what under the various scenarios, what were the main impacts of climate change on investment returns?
So in 2011, we published our first study on the potential impact of climate change on different asset classes. And this time with this study, we have actually extended it to the sector level. And we felt that that was really important because, of course, some sectors are more vulnerable than others. Overall, we found that all climate scenarios have an impact on investment returns, and therefore uncertainty shouldn't itself be a barrier to investors taking action. The impacts at the scenario or at the sector level were actually more significant than at the asset class level. And interestingly, they're always in one direction. So the magnitude of impact changes across the scenarios, but the impact at the sector level is always the same. Whereas at the asset class level, under some scenarios, asset classes may perform better, and under different scenarios, the same asset class may actually perform more poorly. So that provides a bit of a challenge for investors in terms of thinking about how to best position their portfolio. And really the sector level impacts being so significant also present a challenge because the typical investment committee discussion we'll look at optimal asset allocation, we'll look at allocating to managers in different asset classes and regions, but investment committees don't tend to spend a lot of time talking about their sector level exposure. It's not part of the typical investment committee agenda discussion. So that's something that's kind of new and challenging with this report, and I think that something we'll see investment committees spending more time on.
And are we seeing much evidence of investors making portfolio shifts in response to the risks associated with climate change?
Definitely, we're seeing more of this activity than we've ever seen before. However, in the grand scheme of things, I think the biggest kind of group of investor activity that we're seeing around climate is still focused on engagement. Engagement with regulators and policymakers calling for an aggressive climate deal in Paris. Increasingly, we're seeing a lot of investor engagement with companies, asking them to have 2-degree compliant business plans. But more recently, over the last year, 2 years, we're definitely seeing more activity at the portfolio level as well. That's the harder area to get into, but we're seeing a lot of activity and a lot of engagement. Looking both at risk and opportunity. So on the risk management side, it's really, to make your portfolio more resilient against a mitigation scenario, whether it's a 2-degree or a 3-degree type scenario. It's really, a big part of it's around managing climate policy risk. So that then leads investors to say, okay, well, what is my climate policy risk in my portfolio? And towards a path of kind of decarbonizing portfolios. So you see a number of industry initiatives around that, and in fact a number of new low carbon indices which are available to help investors in that respect. But we're also seeing investors really allocating towards the opportunity. So where there's an economic transition, there's going to be opportunity. So that's an area that we're also working with a number of investors on, both on the listed and the unlisted side, in terms of really kind of putting money to work in this new low carbon transition.
Is divestment really the answer? I mean, there's a lot of noise around the fact that a growing number of asset owners are actually just selling out of their coal and oil and gas company holdings.
To us, to divest or not to divest is not the right question. The question is, what is your climate risk and how can you manage it? So that's really what our framework is focused on. I think a lot of the pressure and focus on divestment is coming more from the political angle and more of a political discussion. And in fact, it often is a catalyst for investment committees to really think about how to take action. But for investors who are functioning as fiduciaries, as long-term investors really seeking to optimize their long-term risk-adjusted return, the question is, how can climate change and climate risks impact my portfolio and what can I do about it? So that may lead investors to tilt away from higher carbon stocks, to reduce their exposure to energy, but it'll be done so in the context of really managing risk and looking for good long-term opportunity.
So you don't believe that climate change is entirely negative for investors, that there are actually opportunities that can arise out of adapting to global warming?
Certainly. We see a lot of opportunity out there, both on the adaptation side as well as on the mitigation side. So energy efficiency, resource efficiency, companies, stocks, and sectors focused on really transitioning towards a lower carbon economy presents a lot of opportunities for investors. And it's something that we think is really interesting and exciting. And there are a number of investors already kind of operating in this space, but I think it's an area that we're going to see more activity.
Jane Ambachtsheer of Mercer, thank you very much for joining us today.
Thank you.
And for more on this topic, go to ft.com/FTfm.